Hey everybody, Marty Mazur. Good morning, 9th of February 2019. I'm going to do the weekly message on the video once again. Right now, the technicals I think are important. Not that they're not always important to some degree, but for me, they actually help you put all of this into perspective. Technical analysis does give us signals. I'm more fundamentally driven, certainly in my own investment portfolio and certainly as we approach client portfolios. But the technicals matter. They do give us a good feel for what's going on under the surface, what shorter term traders are thinking, how they're reacting to news headlines, and so on. There's just a wealth of information that if you understand chart patterns and some of these other indicators that can be very helpful, it can really give you a feel for what's going on. And for us, or for me with clients, I just think it's important to let you know what I'm thinking, even on a short-term basis. Even though we're long-term investors, there is so much information out there. There is so much news desperate to get your attention. Frankly, the media will do anything to get your attention, and it's not always good information. So I'm here to do the best I can and help you weed through the noise and put the right perspective on it, or help you understand what probability suggests going forward, so that when we experience volatility, good or bad, we can have an understanding of what's beneath the noise and maybe what the prospects are for our portfolios further out. So that's really the purpose of the blog, and it's really directed at clients. So this morning, what I'll do is just quickly run through some of the technical indicators I've been sharing. I'll comment on them along the way, and then I'll just close with the present environment and what we see going on. So Thursday and Friday actually were impressive days, frankly, even though for the Dow they were both down. The S&P, which is what we're tracking here, actually closed higher on Friday. And that was not what I expected. I would have told you there was little or no chance that that would have happened. A rush of buying came in right at the end. I suspect it may have had something to do with news that as early as Monday, it looks like Washington is going to compromise on keeping the government open, and we're not going to go through round two of that mess. Round one really, I don't think, did much damage to the market, but I think round two could be ugly, at least on a short-term basis. And the notion that that's not going to happen could give a little bit of a short-term boost. Now, whether or not that short-term boost turns into a longer-term boost also hinges on some things that are happening next week, and that is the U.S. trade delegation will be in Beijing. The news that sparked this gap lower and this failure of the 200-day moving average, make no mistake, was that President Trump and President Xi will not be meeting before the deadline. That there's quite the chasm separating both sides in terms of what they're going to agree on. And that conflicted with the news that really helped force this market up through this resistance level and butting against that 200-day moving average. So the market traders really didn't know quite what to do with that other than, of course, sell it off. So here we have, again, 200-day moving average, 50-day moving average now sloping higher. We're on the verge of an upward sloping 200-day moving average, which is a bullish trend sign. So that's positive as well from a technical perspective. I don't have a chart to express this, but I will tell you that the late day trading, again, I mentioned it on Friday, has been impressive throughout this advance. You look for commitment at the end of the day. There's an old Wall Street adage, amateurs trade the open, the pros trade the close. Some people still put weight on that. I don't necessarily disagree, but I can tell you pros do trade the open as well. But that late day buying, if the smart money doesn't think it's a good idea to hold stocks into the Asian session, they're going to sell. So we have seen that, which of course is exactly the opposite of what we saw pretty much throughout here. So that's another bullish sign, along with the moving averages. I've showed you recently the unbalanced volume. That says that on net, folks are accumulating stocks in here as they go up. You have periods actually at times where stocks go up and unbalanced volume actually can trend lower. Back in here, you see how stocks are actually still rising and trending higher. Look at unbalanced volume. It had already rolled over, giving kind of an ominous signal about what's to come. And you may recall I wrote an article in here that said expect a rough patch, partly because these technicals were rolling over. I had a flat to up market and had a bearish divergences in unbalanced volume, the MACD, and the RSI. Today, we have bullish divergences in all of those. So that tells us that money is coming in and accumulating stocks on the way up. Another technical indicator, if you will, that I think is extremely important is the advanced decline line, the cumulative advanced decline line, your breadth indicator. So what this one goes up, there's more advancers in a given day in the S&P 500 than there are decliners. It goes down when there are more decliners than there are advancers. So you see back here from September to current, this downdraft, as we try to work our way out of it. Notice the advanced decline line is actually moved above into new all-time high territory. Stocks have been falling, and the bigger market caps that make up more of the S&P 500 have been falling. The actual number of stocks advancing over decliners has actually been trending higher, and that's a very, very positive look. Let me tell you why. Here's the S&P 500 in yellow. Here's the advanced decline line in blue. Notice here, right before the worst recession and bear market since the Great Depression, stocks were mounting their way to a new all-time high. The advanced decline line was rolling over. While the index was going up in price, the number of decliners was greater than the number of advancers. Notice here, in 2011, we had a correction that virtually the same percentage as we had here. It was 19 point something percent. But the advanced decline line was hanging in there, was actually positive, and then right in here it broke out before the actual index did. Then we had that long, nauseating consolidation between 2014 and 2016. Had the same thing here in the AD line. However, look way back here in March of 2016, it broke out to the upside, sending a strong signal that that was the direction that this breakout was going to be as well. And then again, here we sit today. So this has been a very reliable long-term trend indicator, along with all the other ones I've been showing you of late. Tells me that odds suggest that this bull market is not yet over, that it's got more room to run. And that's what the fundamentals say as well. I'd like to share our PWA proprietary macro index here. You may have noticed I haven't in the last several weeks. Now, I will tell you that actually the scores have been going up. The scores are better than they were just a month ago. And that's encouraging as well. The reason I haven't been advertising it is because there's a big asterisk on each score the last few weeks, and that's because of the government shutdown. Enough of the data is produced by government agencies that were shuttered. That needs to catch up, and that will, I'm sure, over the next 2, 3, 4 weeks. But again, so I will tell you, though, with some confidence that the underlying fundamentals look pretty good to me. Now, in closing, when I look at the world, when I step back and I take that 30,000-foot view, the data each night is mixed. There's some good data mixed with the bad, but on balance, it's a slower growth type situation. A protracted trade war, an escalated one. I can tell you, this is one prediction I do not mind making. That will create a global recession and a real ugly bear market throughout the world. And it'll come long before it's due, and it'll come at a time when the Fed is not prepared. Interest rates aren't high enough. The Fed's balance sheet is too large. And the federal government has just cut taxes and increased spending. So you're not going to have a tremendous amount of fiscal and monetary firepower to do much about it. So it is not time to have a recession. And that's what concerns me, folks. While I show you the technicals, clearly the market, traders in the aggregate are feeling pretty bullish right now. To me, that's obvious. We actually are in a good position going forward for a while. This trade war stuff could be so disruptive. Our index score was an 81.5 on January 15th of 2018. It does not get any better than that. It got all the way down to 20 here at the bottom of this market decline. But when the market peaked, it had dropped down to 38. And as I'm crunching these numbers and looking at the sentiment indicators and so forth, the big, gigantic elephant was fear over a trade war. So that clearly, if the market's right, we're going to get an agreement on China soon. I do think the market is ignoring Europe. And I'm not talking about Brexit. Brexit's in play. We'll see how that plays out. What I'm talking about is 25% tariffs that are pending on German automobiles coming into the U.S. I don't know that the market can take much more of this. So if we get out of this China trade war and the market moves its way up to new all-time highs and so forth, which is what we should expect, all we can really do is hope that the signals in the global economy and the signals in the market will inspire the players not to go hard after our Western European allies on trade. I'm not saying there are some things that could be fixed. I just don't think it's as broken as some would have us believe. And I do think it would break the market if we go at it too hard. I know that's a somewhat ominous sounding way to end this week's message. But really, when you look at the internals of the market, you look at the technicals, you look at the prospects for cooler heads to prevail, we really should be bullish right in here. If general conditions do roll over while we're playing these games on trade, then I'm going to be very bearish. I'm going to show you videos where my technical indicators are broken down, where these are bearish divergences, not bullish divergences. And you clients out there, I'm going to be telling you what we'll be doing in your portfolios to try to mitigate some of the downside risks that we'll be seeing. That's just not what we're seeing right now. I think if good decisions are made, this bull market can go for a ways longer. And of course, anything can happen on a short-term basis. We're looking at the longer-term indicators to try to get a feel if our current allocation across sectors, across regions of the world makes sense relative to general conditions. Right now, I feel very strongly if it does. I look for big bounces in certain areas. So I'm optimistic in a no trade war environment. I am very pessimistic in a long-term trade war environment. I'll leave it there. I hope you all have a wonderful weekend, and I'll talk to you again very soon. Take care. Bye-bye.